In chemistry, a reaction only happens when the conditions are right. It's no different in real estate. Welcome to the Alkaline Reaction, a podcast from Alkaline Advisors, where we break down the deals, partners, and capital structures that turn opportunities into outcomes. I'm Spencer Carenti, and today's reaction, cap rate compression, and the most expensive thing nobody underwrote. There's a wall in an office somewhere that I want you to picture. It belongs to a sponsor, a good one. On that wall is a row of framed deals, bought in 2012, sold in 2018, bought in 2015, sold in 2021. Every one a winner. Doubled the equity here, tripled it there. It's a beautiful wall. He earned it, or at least he believes he did. And most people who walk past it believe it too. He looks at that wall and he sees a track record. He sees judgment. He sees the proof that he is good at this. And he might be, but there's something hanging on the wall behind his wall. A second chart he never framed, because nobody frames it. It's the interest rate chart. And for the entire length of his career, it pointed in one direction, down. Here's the uncomfortable question this episode is going to sit with. How much of that beautiful wall was him? And how much was the chart behind it? Let's start with the machine, because this isn't a mood, it's mechanics. A cap rate is just the price the market puts on a dollar of real estate income. A 6 cap means you pay roughly $16 for every dollar of net operating income. A 4 cap means you pay $25. Same dollar of income, wildly different price. And cap rates move with interest rates broadly over time. When the cost of money falls for 30 years, and it did from the early 1980s until just recently, cap rates fall with it, which means the price of every dollar of real estate income rises. Not because the building got better, not because the operator got smarter, because money got cheaper, and cheap money bids up the price of everything that throws off income. This is one of those forces that's almost invisible while it's happening, because it happens slowly and in your favor. A rising tide doesn't feel like luck when you're the one on the boat. It feels like seamanship. Now here's the turn. Imagine our sponsor buys a building at a 6 cap. He does everything right, leases it up, runs it well, raises the income a little. He deserves credit for that. But while he owns it, cap rates drift from 6 to 4. And when he sells, that drift, that thing he did nothing to cause, has done more for his return than all of his operating skill combined. He will not experience it that way. He'll remember the lease he signed, the renovation he pushed through, the broker he out-negotiated. Those are the stories with a hero in them. Nobody tells the story of the macro tailwind because there's no hero in it. There's just weather. Charlie Munger would point out exactly what's happening here. It's a stack of biases reinforcing each other. We take credit for outcomes we didn't cause. We remember the decisions and forget the conditions. And we are powerfully motivated to believe the returns were skill, because skill is repeatable and luck is not, and no one wants to believe their best years are behind them by accident. And Warren Buffett gave us the cleanest line ever written about this. Only when the tide goes out do you find out who's been swimming naked. For 30 years, the tide was coming in. Almost everyone looked like a strong swimmer. You could not tell the difference between the operator who is genuinely good and the one who is simply standing in a rising ocean. That's the part worth saying plainly and saying as we, because it implicates the whole industry, not one man at one wall. A generation of real estate returns came not from operating genius, but from a 30-year decline in the cost of money. We mistook the tide for talent, most of us, most of the time. And now the tide is going out. The same machine that lifted everything runs in reverse. The cost of money rose. And as it did, cap rates stopped falling and began to widen. 6 caps drifting back toward 7 and 8. Watch what that does. Using the same building, say it produces $1 million of income. At a 4 cap, that building is worth $25 million. Push the cap rate to 6, and the building is worth a little over 16. The income never changed. Not by $1. The building is the same building with the same tenants on the same street, but $9 million of value evaporated because the price of $1 of income reset. This is why so many sponsors are quietly discovering something painful right now. The deal didn't fail because they ran it badly. It failed because they bought beta and called it alpha. They bought the tailwind, financed it like it would last forever, and the tailwind reversed. The refinance doesn't pencil. The exit cap is higher than the entry cap. The wall of winners has a blank frame waiting at the end of the row. Michael Burry built a career on a single unfashionable habit, being willing to say the number out loud when everyone around him was incentivized not to. This is that number. A great deal of what looked like a decade of brilliance was a decade of declining rates wearing a very convincing costume. So, is it all luck? No. And this is the part that matters most. Skill is real. It always was. It was just impossible to see while the tide was covering everything. And here's the genuinely hopeful thing. For the first time in a generation, you can actually tell the difference. Because when the tailwind is gone, the only returns left are the ones you create on purpose. Buying at a basis low enough to forgive a mistake. Raising income through real operational work, not market drift. Structuring debt that survives a higher rate world instead of praying for a lower one. Finding the asset the market has mispriced for a reason you understand and others don't. That's alpha. And the irony is almost gentle. The environment that humbles the lucky operator is the exact environment that finally rewards the skilled one. When everyone's returns came from the tide, skill was invisible. Now that the tide is out, skill is the only thing left standing. The sponsor with the beautiful wall has a choice. He can keep believing it was all him and get humbled by the reversal. Or he can look honestly at how much of it was the chart behind the chart and ask the only question that matters now. What can I do that the weather can't do for me anymore? That's the work we do at Alkaline Advisors. We separate the tide from the talent. We pull the compression out of a track record so you can see the operating return underneath it, and we underwrite the exit cap honestly, in a world where rates don't fall to save the deal. Because the deal is won or lost in the structure and the downside, not the headline return. That's today's reaction. If you found this episode helpful, please subscribe and join us next time as we continue breaking down the commercial real estate industry. I'm Spencer Carenti, and thank you for your time.